The United States stock market is currently closed today, Friday, July 3, 2026, in observance of the Independence Day holiday, so we are evaluating the asset based on its most recent closing figures. Ondas Holdings, Inc., trading under the ticker symbol ONDS, finished the regular trading session on Thursday, July 2, 2026, at exactly $7.41 per share, marking an intraday decline of 6.44% during the final session of the week. While a quick look at that down day might make it seem like a minor tech stock losing ground before a holiday weekend, the underlying numbers reveal something much more fascinating. This company recently posted a staggering revenue increase of over 1,000% year-over-year for the first quarter, backed by a massive $457 million pro forma backlog. The immediate surprise here is that despite this eye-popping top-line expansion and a wave of massive high-profile defense partnerships, the equity has shed nearly half its value from its recent high of $14.16 reached just last month. This creates a fascinating contradiction between explosive business growth and severe equity depreciation that demands a closer look. When people look at an asset like this, the general expectation among the retail crowd is that 10 times revenue growth mixed with military tech deals should automatically send a stock to the moon. Many participants using a basic individual brokerage account assume that a surge in defense spending and public sector demand makes a company bulletproof. The reality, however, is that aggressive corporate expansion through massive corporate roll-ups can severely punish current shareholders. Ondas has been on a frantic acquisition spree, closing 6 major deals recently, including the $175 million Mistral merger and the $125 million purchase of Cyberhawk. To fund this rapid expansion, management is seeking to dramatically raise their authorized share capital to a staggering 1.2 billion shares. This massive threat of equity dilution is the cold reality colliding with the high-flying growth expectations, forcing market participants to weigh the benefits of long-term scale against the immediate pain of getting their ownership stakes diluted. Understanding recent trading behavior requires analyzing the massive daily volume swings that have come to define this ticker. Throughout late June and early July, daily trading volumes have routinely breached 80 million shares, far exceeding the historical averages. A significant portion of this liquidity is being driven by retail traders executing quick plays on the Robinhood app and utilizing Robinhood stock trading tools to capture rapid intraday price shifts. Because the stock has experienced massive volatility, swinging from over $13 down to the $7 range in a matter of weeks, it has become a hotbed for speculative online investing. Unlike stable long-term holdings such as Apple stock or Nvidia stock, which people tend to accumulate quietly in their retirement portfolios, Ondas is treated as a battleground asset. The massive trading volume reflects a fierce tug-of-war between retail buyers trying to spark a short squeeze and institutional short sellers who have pushed the short interest to an elevated level near 34% of the float. This massive short interest has created an environment where any piece of minor news can trigger a violent double-digit percentage swing. For instance, when the company announced that its Centrix subsidiary was collaborating with Lockheed Martin to integrate its cyber-over-radio frequency counter-drone technology into the Sanctum platform, the stock experienced a temporary surge. Traders using the Fidelity mobile app and managing self-investing strategies rushed into the asset, viewing the defense partnership as a massive validation of the corporate technology. However, just days later, the reality of a secondary share offering tied to the Omnisys acquisition overhang hit the market, causing a sharp downward correction. This constant push and pull between fundamental operational progress and structural equity dilution is exactly why investors seeking solid investment help are left scratching their heads when tracking this asset on popular investing sites. For individuals managing their own capital through a platform like SoFi Invest or setting up automated asset allocation models via Schwab Intelligent Portfolios, high-growth microcap names present a massive challenge. When you look at standard automated wealth solutions like an intelligent portfolio or a robo-advisor, they typically steer completely clear of highly volatile entities like Ondas, opting instead for broad basket fidelity ETFs or predictable large-cap equities. The reason is that the price discovery mechanism for a company undergoing a radical corporate transformation is incredibly messy. During the recent June index reconstitution, the stock was officially added to both the Russell 2000 and the Russell 3000 indexes. This inclusion triggered a massive wave of mandatory passive buying from institutional index funds, providing a temporary cushion against the heavy selling pressure. Yet even with institutional passive flows pouring in, the broader macroeconomic environment and tech sector profit-taking have continued to place a heavy lid on the share price. To truly understand what this enterprise does, we have to look past the chaotic daily trading charts and examine the actual business model. Ondas operates primarily through two core segments, Ondas Networks and Oasis Autonomous Systems. The Networks division focuses on proprietary wireless data technologies designed for critical infrastructure applications, such as large-scale railroads, utilities, and oil and gas operations. The Autonomous Systems division, powered by their acquisitions like American Robotics and Airobotics, builds fully automated drone systems that perform industrial inspections and security monitoring without requiring an on-site human operator. By buying up complementary businesses like Cyberhawk, they are attempting to build an end-to-end data acquisition and analytics platform for global infrastructure. Comment below how many shares of Ondas Holdings you currently hold in your portfolio, or if you prefer sticking to larger defense names instead. Looking closely at past financial reports, the company has historically operated at a significant loss, which is typical for early-stage technology providers trying to build out a massive footprint. While the recent top-line revenue explosion to $50.1 million in a single quarter looks incredible on a slide deck, the adjusted EBITDA remains deeply in negative territory. This operational cash burn explains why the corporate entities must continually return to the capital markets to issue more paper, keeping the dilution machine running at full speed. Experienced active traders who execute complex orders via the Interactive Brokers platform or track order flow through Interactive Brokers trading tools closely monitor these cash burn metrics. They know that a company cannot rely on printing new shares indefinitely to fund its operations, especially when interest rates and macroeconomic pressures make capital conservation a top priority for institutional asset allocators. When comparing this situation to standard large-cap tech investing, the structural differences are massive. If someone buys Tesla stock on a retail active platform, they are speculating on consumer auto demand, autonomous software adoption, and global manufacturing capacity. When an individual engages in SoFi investing or opens a Fidelity brokerage account to buy shares of Ondas, they are making a highly concentrated bet on the rapid expansion of the commercial drone and counter-unmanned aerial systems markets. The regulatory environment is a massive factor here, as federal drone policies and defense budget allocations heavily dictate how quickly these automated systems can be legally deployed across American airspace and critical infrastructure sites. If federal agencies streamline approval processes for automated beyond visual line of sight drone operations, the addressable market for the company expands dramatically, potentially validating the aggressive acquisition strategy pursued by management. As we look toward the upcoming quarters, with the next major earnings announcement scheduled for August 11th, the tension between expectation and reality will likely reach a boiling point. The market is expecting to see whether the massive pro forma backlog will finally start converting into positive cash flow and net earnings, or if the integration costs of these 6 distinct corporate acquisitions will continue to drag down the operating margin. Speculative retail buyers utilizing platforms like SoFi Active Investing or the Robinhood crypto and cash management ecosystems are hoping for a blowout report that forces short sellers to cover their positions, which could spark a massive upward move toward the median analyst price targets that sit well above current levels. Conversely, risk-averse investors managing their assets through Fidelity mutual funds or structured Fidelity IRAs will likely view the high short interest and the massive authorized share capital increase as a clear signal to remain on the sidelines until the corporate balance sheet stabilizes. Ultimately, the long-term trajectory of this stock will depend entirely on whether management can successfully execute its roll-up strategy without completely destroying shareholder value through infinite dilution. The expectation is that by creating a massive, diversified drone and data conglomerate, the company will achieve an unassailable competitive advantage in the industrial and defense markets. The reality is